Hello, I'm Mansoor Mohideen, and this is Bank of Singapore Research. The economic outlook continues to be challenging for financial markets. First, inflation remains stubbornly high, forcing central banks to keep increasing interest rates. Headline inflation rates in the US, UK, Eurozone and Japan were 6%, 10.4%, 8.5% and 3.3% respectively for February, well above central banks' 2% targets. Only in China is inflation tame at 1%. Thus the Federal Reserve, the European Central Bank, Bank of England, Swiss National Bank and Reserve Bank of Australia all increased interest rates in March. Second, recession risks are high. The US manufacturing ISM survey indicates activity has been contracting over the last 4 months now. The US unemployment rate rose in March from 53-year lows of 3.4 to 3.6%, and the US yield curve, a leading indicator of recession, has been inverted for 9 months now. Third, the sudden failure of banks in the US and Switzerland have increased the risk of credit crunches hurting growth. Depositors have been shifting funds to larger banks. Smaller banks may become less willing to lend to new borrowers. We think the major central banks are nearing the end of their year-long campaign of interest rate hikes to curb inflation. For example, we expect the Fed to increase its Fed funds rate only one more time now in May by 25 basis points to reach a peak of 5 to 5.25%. But investors should maintain a cautious stance while the economic outlook remains uncertain. Global equities, we recommend an overall neutral stance outside Asia. Fixed income, we continue to be overweight US Treasuries and developed market investment grade bonds as safe haven hedges against recession risks. And last, we think other safe havens, including gold and yen, will also be in demand as attention shifts from inflation risks to recession fears and banking woes this year. For more information, please refer to our monthly investment guide titled Rising Headwinds.